Investors should start selling stocks as soon as the next rate cut comes in September. This is the message out of the Bank of America's chief strategist, Michael Harnett. He's reiterated this today after repeating it about a week ago. And what he's saying is as soon as the rate cut comes out of the Federal Reserve, there's going to be more downside in stocks. And I'm going to show you in today's video why, historically speaking, we have to be very careful with this advice, almost becoming consensus now, about shorting after the first rate cut. And I want to show you why the odds state that we should probably be looking for buying opportunities once the Fed starts to cut rates this time. Bank of America's Hartnett says market sell-off yet to breach key levels, sees slump if stock winners fall below 200-day moving average, AI leaders to falter in second half unless profits shine. So what's he alluding to there? He's alluding to the fact that when you have profits and revenues declining, the S&P 500 stocks follow it down. You know, the S&P 500 will rally if earnings are growing, and the S&P 500 will roll over if earnings are rolling over. And if we look at this research from Morgan Stanley, you can see that the S&P 500 earnings revisions breadth are tracking down, and this correlates with the S&P 500 price, suggesting that there is further downside in the S&P 500 as we see the earnings revisions breadth heading lower as well. So what Hartnett is alluding to is the fact that it looks like a US recession is coming, but the question is, as always, when is the recession going to come? Will it be shallow? Will it be deep? Will it be a hard landing or will it be a soft landing? I want to show you in today's video why, whether it's a hard landing or a soft landing, the odds are historically we should probably start looking for potential buying opportunities once the Fed starts to cut rates. So the article continues to say global markets have been jolted in the past month as investors have worried that the Fed has been too slow to cut interest rates in time to avert a recession. So again, they're looking at this idea that a recession is now inevitable, whether the Fed starts to cut or not. And in fact, if the Fed starts to cut, this will be a sign of a hard landing, and this is why investors should start to sell stocks after the first cut. This is what Hartnett goes on to say. And in this video, you're going to see why that's not necessarily the case and why we should be very careful taking that advice. Still, the S&P 500 rebounded after a report Thursday showed a slower than feared cooling in the labor market. The index is now down only 0.5% on the week. Hartnett also reiterated his view that investors should sell into the Fed's first rate cut. He expects winners of the artificial intelligence trade to wallow in the second half until earnings pick up. Stocks are likely to fall when the Federal Reserve delivers its first interest rate cut because the pivot will come as data signal a hard rather than soft landing for the US economy. So the case that Hartnett is making here is that we should go out and we should start selling stocks after the first rate cut because that's a sign that the US is going into recession with a hard landing. Now, implicit in that is that were it to be a soft landing, then investors could go out and buy stocks as interest rates come down. So what I want to do now is we're going to go and have a look at the history of rate hiking cycles, and we're going to look at the first cuts that come and how the S&P responds to the first rate cut. And we're also going to look at it with both soft landings and hard landings so we can see if there's any difference between the two. So what we're looking at here is the S&P 500 index, which is the blue line, and we're looking at the federal funds rate in gold here. And each of these lines down denotes the first rate cut after a hiking cycle. And we're starting off here in 1966. You can see this is dotted rather than dashed because this is a soft landing. So the hard landings are dashed and the soft landings are dotted. Fed Chair Martin at the time raising interest rates because of worries about inflation. You can see once we get that first rate cut in 66, we're already making our way up in the stock market. This is an example, and it is a soft landing, but this is an example of where rate cuts come and we start to see stocks actually rallying coincident with the first rate cut after a rate hiking cycle. Now, in this case, the President, Lyndon B. Johnson, was so annoyed by this tightening cycle, he actually asked if he could fire the Fed chair at the time. And the answer, of course, was no. Moving on then to 1969, you can see we get the peak in the federal funds rate. They start to cut and stocks are already down at this point. And this is another, you could say, soft landing. But in this case, we do see a continued sell-off in stocks. You can see it's roughly, let's say 100% of what was already declined, give or take. So we get the decline, we have a pullback, and then we have a second leg down, which is kind of similar to the initial sell-off. And this was actually one of the first times that we saw fiscal policy coming in. Again, Lyndon Johnson pushing through fiscal policy to help reduce inflation. Could you even imagine that in this day and age with politicians doing something so politically unpopular as, raising taxes to control inflation? Very unlikely. Next, we come to 1974. Now, this certainly was a hard landing. In fact, this was one of the deepest recessions, in fact, the deepest in the post-World War II history. So there's no question that this was a hard landing. Now you can see, and this is where Arthur Burns enters the picture, of course, the kind of historical Federal Reserve piñata everyone likes to kind of beat up on. And you can see when we do get the peak in the federal funds rate, we actually are coincident here with a bottom in the stock market. Now, in hindsight, this is one of the things we have to contend with because we don't know, if Federal Reserve do cut rates, are they going to start raising rates again? But assuming that they cut rates in September and this is the peak of this rate hiking cycle, then you can see in this case, the peak of the rate hiking cycle did coincide with a bottom in the stock market. We actually bottomed and had a huge rally after the interest rate hiking cycle ended. It peaked and we got the first cut after the peak. So there can really be no argument about that one. That was absolutely a hard landing. And the peak of the hiking cycle and that first cut, assuming it is the peak this time, that coincided with a major bottom in the stock market. So moving on to 1980, and you can see we get a peak, we get a cut. This is a steep cut, a big cut. And that was after we had this correction in the stock market. And you can see, again, another hard landing where the first rate cut at the peak here is coincident with a bottom and a continued run up in the stock market. So there's two in a row here, both in inflationary regimes as well, where we see interest rates cut and the cut is coincident with a run up in the stock market. Now, in this case, we continue to see interest rates go up. And of course, this is where Volcker steps in, smashes interest rates up, and we get that secondary deep hard landing in 1981. So moving on then to the rate cut here, which as you can see is right in the middle of Volcker breaking the back of inflation with that gigantic rate hike back in 1981. He does eventually get credit and does break the back of inflation. And as you can see, the rate cut comes, the peak of the cycle. And the reason why I'm not counting this as the peak of the cycle is because there was a recession here as well. But this new rate hiking cycle, which peaks over in July, you can see we're again about halfway down. So in both instances where we do get further downside, we can see at least in these two scenarios that usually you're probably going to get double what you've already got if you do get stocks continue to decline. And in a moment, we're going to tally these up and we're going to see how many times the market went higher and how many times the market went lower after the peak of the hiking cycle in the first rate cut. Moving on then to 1984, and you can see we get this 18-month hiking cycle. Notice the difference here. This ends in a soft landing, and you can see, look how shallow this tightening cycle is. When the Federal Reserve is raising rates very slowly over a longer period of time, much more likely that you're going to get a soft landing. When you get big rate hikes, and 50 basis points, 75 basis points, this tends to coincide with a hard landing. It is why I do agree with Hartnett that a hard landing is likely. But the question is a hard landing necessarily going to see stocks continue lower? And we're going to find out the answer to that fairly soon. So the first rate cut in 84 was in fact super bullish for stocks. May have come down a little bit initially, but you can see nothing significant. Certainly not comparable to 81 or 69. These are continued bear markets, and that's what we're really talking about, not some, month-to-month volatility. But when we get the run-up in 84 into the back end of the decade, you can see we end with Black Monday, the first contemporary financial crisis, 1987 Black Monday, and we have this massive sell-off. And you can see it's not really linked to, we do have the raising of rates, but nothing significant. And after this kind of exuberance, after the 84 soft landing kind of wears off, and we get that correction, you can see we continue to go higher until the 1989 rate hiking cycle, which ends in April 89. Now, in 1989, we do get hard landing and we do get the first rate cut coming in April. And look at stocks, they continue higher. And in fact, stocks continued to march higher after the end of the hiking cycle, almost straight away, if not straight away. And they only started to sell off once we saw the invasion of Kuwait, and this is where you see this big sell-off. Now, even with the invasion of Kuwait basically ruining this stock rally, this sell-off only really comes back to roughly where stocks were to begin with. So even if you got involved somewhere around the first rate cut, you still would not really have been much underwater, maybe a little bit, after the invasion of Kuwait took place. And of course, if you book profits before that, there was actually quite a bit of upside before we saw the bigger correction and the recession in the early 90s. So now we come to 1995, and it's the poster boy of soft landings. When anybody talks about a soft landing, they always reference the 95 Greenspan soft landing. This is the kind of ultimate soft landing that everybody wants to achieve, in the Federal Reserve if they are trying to land the economy. It's the 95 Greenspan soft landing that everybody's trying to emulate. So you can see in 1995, we get the first rate cut after the hiking cycle, and stocks just take off. I mean, this is for sure a soft landing, and it's really an immaculate landing of the US economy. And part of the reason was because of the preemptive raising of rates. Greenspan started to raise rates before inflation became a problem. It was roughly around 3% or so when he started to raise rates. So there's a couple of things to take away here. One, if you have a very slow hiking cycle over an extended period of time, you can get a soft landing. And the second thing that we're seeing here as well is that if rates are raised preemptively before inflation gets out of control, you can have a soft landing. Now compare that to what happened this cycle with Jerome Powell raising rates at 8.5%. Another reason why I think we're heading towards a hard landing. But again, are stocks going to sell off after the first rate cut? This is the question that we're looking to answer in this video. So moving on then to the next recession in 2001, 2000, of course, the dot-com bubble. Everybody knows these recessions now. We're starting to come towards the kind of modern era. And this is just a perfect example of what Hartnett is making the case for, which is that when the first rate cut comes, we should expect stocks to suffer. We see this pretty much top ticks it in the dot-com era. Also in the 2007 great financial crisis in 2008, we get the first rate cut, and that is essentially coincident with the top of the market. That is where the market essentially peaks. And in both cases, not only does the first rate cut more or less top tick the market, but we have 50% declines in both of these situations. And certainly what's also interesting is, again, with these two recessions kind of one after the other, neither of these took place in an inflationary cycle. And I'm defining an inflationary cycle here as elevated inflation above 7.5%. And especially when you think back to that Arthur Burns cutting and inflation starts to pick up again, and we get stocks actually continuing higher because, of course, inflation is supportive of asset prices. So two kind of case and points about what Hartnett is talking about, but I question whether that is going to be replicated in the higher inflationary regime that we've been in and are still currently in. And of course, then the COVID recession, where we get the first rate cut and the end of the hiking cycle, May 19. And you can see it actually coincides with an absolute bottom here. We get roughly a 25% rally after the first rate cut. We do then, of course, get the global shutdown, very similar to the invasion of Kuwait, where we see the rate cut, we see stocks actually respond positively, and then we get some kind of catalyst, in this case, the closing down of the global economy, and we get that bigger sell-off. And in this case as well, it kind of came down a little bit deeper this time because of the deflationary shock, but it kind of came down pretty similar to where the initial rate cut started. So, is the first rate cut at the peak of a hiking cycle bullish or bearish for stocks? Well, out of the 11 rate hiking cycles that we've just looked at, 7 of them, after the first rate cut, had substantial forward returns, about 64%, versus only 4 out of 11 that saw continued significant declines after the first rate cut. Now, if you take out the soft landings, because Hartnett did say that he believes the reason for this is because a rate cut is going to signal a hard landing in this case. Well, if you take out the soft landings, that leaves 7 cycles, and out of those 7, 4 of them actually were coincident with significant forward returns in stocks. 3 of them were events where the first rate cut signaled further declines. So again, even if you take out the soft landings, 57% of the hard landings that took place did see significant forward returns after the first rate cut. And finally, just to drill down even further, out of all of those hiking cycles, only 3 were inflationary cycles where inflation was over 7.5%. In 74, where we saw that rate cut coincident with the absolute bottom and a big rally in stocks. 1980, where the rate cut was also coincident in a bottom with stocks. And then 1981, where we saw Volcker hammering interest rates up. And in that case, the first rate cut did see forward declines. So even out of those 3, and it's a small data set, but we don't have thousands and thousands of cycles to look at, but even of the last 3, hard landings with inflation above 7.5%, 2 out of 3 were actually showing very good returns and a bottom in and around that first rate cut. And I would argue that those 3 are probably, in all likelihood, better analogs for us to be using for this hiking cycle. And again, you could take this a little bit further and say out of the 3, the reason why we had forward declines in the 81 Volcker shock was because of how high he raised interest rates. But I would say this cycle is even more analogous with the kind of reinflation and the bottom in stocks that we saw, maybe in 74 and even 80. And I want to wrap up the video with this because Hartnett did also say something yesterday, which I thought was very interesting. He did say a renewed slide would mean that the next support for the S&P 500 would kick in at the highs of 2021, implying a drop of another 10% for the benchmark. Now, of course, why did I find it interesting that Hartnett came out and said that yesterday? Because on Wednesday, I released a video to you guys saying that that's exactly where I think we're going to come back to in the S&P, and why I think we're heading for a more shallow correction in stocks, roughly 15%, into the prior high before we should start looking for a potential bottom in the S&P 500 and in US stocks. You can see on a daily time horizon, we did start to become overcrowded. Sentiment got too extreme, and that's why we paused and we started to reverse higher. But I do think, just as Hartnett said, there is a very good chance we continue to slide down towards the 2021 highs. And that would set us up perfectly for a 15% correction. Now, if you didn't watch my video on Wednesday, don't worry, because it's coming up after this video. I go through why I think, based on previous exogenous shocks like we just saw with the yen carry trade, why I think we're probably going to get a shallow correction in stocks rather than a very deep correction like the 50% we saw in 01 and 08. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge Hedge-Trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge Hedge-platform is included with every GMT membership.